Welcome, Drew. Today we're talking about AI. We're talking about rates, especially what is happening with private credit in Australia. We're talking about should we keep investing? Markets at an all-time high. And the last one, of course, probably appear on every monthly episode is Trump. What's happening with Trump?
I don't even know where to start here. I mean, probably the most topical thing that came up in the last few weeks was DeepSeek, the artificial intelligence bot or the competitor to OpenAI. OpenAI's ChatGPT. I know you're a prolific user of ChatGPT.
I am, yes. Yeah, I'm a fan.
All the computers in the office slow down when you're chatting on ChatGPT.
And the lights dim a little bit.
Yeah, it's kind of amazing. Like, for the people who haven't used it before, I talk to my parents all the time about it, try to get them to use it. It's basically, these are large language models that they're acting rather than when you go on Google and it'll find you a website that gives you the answer. It actually gives you the answer. So you can do anything on there. And you can probably explain it better, but you could ask for a business plan. You could ask for a 5-day tour of Scotland. And it'll give you...
Can people ask for a financial plan?
No, not legally, no, not yet. But it can be used for so many different things.
We've said to everyone, go on and try ChatGPT.
Go play with it, particularly our team as well.
Yeah.
And I think it's massive and it's changing the way businesses, and it's not just in these...
But why did the markets react when this new technology came out around AI, and obviously it's a Chinese company, and China's got 1.8 billion people, so everyone's adapting to AI and using AI, and this is a new program. But then global stock markets dropped by, tech dropped by 3-5% over that period of time.
Nvidia dropped by 17% on the day, and it recovered a little bit after.
But Nvidia doesn't own AI.
It kind of does.
Maybe.
This is where the story comes in. I mean, it's interesting because ChatGPT had the fastest user growth of any technology platform or software in all of history. It tells you how powerful
ChatGPT is majority owned by Microsoft.
Yeah. Exactly. Okay. And essentially what happened is DeepSeek, the Chinese version, came out and said that they had been able to put together a realistic competitor to ChatGPT, but only spent $6 or $7 million to do it.
And they said 5.2 million.
And didn't need to use anywhere near the number of chips that ChatGPT uses. So to power AI, you need huge amounts of, essentially only NVIDIA has the chips for this level of computing power. And so basically what they said was that they could build it off nothing. They need no power to run it, which were claims that weren't substantiated by anything, but they were enough to send the market down, I think, like close to 5%, and individual companies down 17 to 20% in just a few minutes. But it turns out since Microsoft came out a week or so later, and we're talking about the fact that someone had been inappropriately accessing all the data, because OpenAI is open, so you can actually get all the information. So someone had been accessing that to build their own large language model, and then it kind of all starts to make sense. But what I found interesting was, I know you kind of asked this question, is given how swiftly things sold off on one little piece of news that wasn't even substantiated, are we just waiting for an opportunity to sell? Does it feel like the market's just ready to fall?
I think that's been the case for 30 years. Essentially, you're looking for any news to sell, right? Even when you think about economic outlook as an advisor, as a client, and we've been doing this for a long time, there's always a reason to sell, right? If it's geopolitical tension sitting in the Middle East or sitting in Asia, or if it's tech's overvalued or undervalued, there's always a reason to sell. If you're a nervous investor, it's incredibly daunting, especially if you leave the news on, if you read the papers, if you watch some volatility, if you watch the share prices daily or hourly, it drive you crazy, right?
Oh, freaks. Like we actually got quite a few emails during that week and subsequent to that as well. But I think more than anything, the artificial intelligence story isn't changing.
Yeah, I mean, NVIDIA is a really interesting client story. As many clients sell NVIDIA here directly, and we've sold it off twice, halved it, and then
still worth 10 times more than they put in.
Try to get clients to sell it. They're reluctant because winners are hard to sell, a bit like CSL and CBA. The stocks that people have made kind of intergenerational wealth. They don't want to sell them, but when they fall, they're the first to email and go, "Ooh, hang on." should I be selling it? So.
It's important because every single investor has exposure to NVIDIA, whether you're in an industry fund, whether you're investing in the likes of Munro, GQG, even the SP 500. NVIDIA is one of the three biggest companies in the world.
Australia, nearly every investor.
It matters to everyone.
I think there was a stat with the Australian super funds. They have enormous exposure to NVIDIA.
Yeah.
So basically every Australian is invested in NVIDIA, directly or indirectly.
And so they should be. I mean, I think artificial intelligence is still going to be one of the biggest thematics and trends you're going to see. It doesn't mean everything's going to win.
Though,
chip. It's cyclical. It was only like 5 years ago where everyone was selling it because they thought no one wanted to buy more computer chips. They couldn't make enough.
Well, 5 years ago they used to do graphic cards.
Now they're powering data centers everywhere.
Let's talk about rates. Rates are exciting. US kept them on hold a few more days.
They cut by 50, was that last year? Yeah. And then kept them on hold a week or so ago.
Yeah, that's right.
And we're I'm still confused about the Reserve Bank. It used to be there every Tuesday.
I thought it was Valentine's Day, but it's not Valentine's
Day. It's the 17th and 18th of February now. So they've gone to like a European and a US style approach to rate decisions. So we'll be waiting till the 17th of February. And now there is, so the market, the yield curve prices in what they expect to happen with interest rates. And it's currently predicting a 90% chance of rates being cut in February.
By 25 basis points.
By 25 basis points, yeah.
Yeah.
But then interestingly, most other central banks historically have always, and you've said this all the time, which I've stolen on multiple occasions, it's usually 50 to 75 basis points.
Correct.
That's the first move
to make to kind of get traction.
Yeah. So, that's in reaction, and it's. I feel like the vast majority of economists, probably shouldn't do that, but economists are predicting it, but that doesn't always mean it's right.
That means it's wrong.
Yeah, definitely. And it's probably triggered supported by the fact that inflation's finally fallen to 2.3%.
Yep.
So it's still within the 2 to 3% band that everyone talks about. For some reason, we want it lower than 2%.
Sure.
But that not to say that actually represents the inflation that our clients, that most people are experiencing out there.
Yeah.
Rents have gone up, mortgage repayments have gone up significantly faster than
food's gone up.
Yeah.
And in the US, it's about 3%. So it's interesting to say that it's 3%, but everyone still wants it to be lower, even though it's in their official band. But at the higher end now. Used to be 6 or 7, but 3% is still too high. So,
and what do you think that means for portfolios?
I think there's been a substantial shift in portfolio design, especially within Waddle over the last 5 years, where we've gone back to a more traditional balanced portfolio, and for some clients, even reducing the risk within their portfolio. So I think it's still good. The current rate market is still good to build a diversified portfolio. You probably will see, as rates go down, you will see bond funds. If you're exposed to any type of duration within bond funds, you'll make some money there.
Yeah.
I think there's been some real pain by higher rates into small and mid companies. And you're probably seeing that come through some earnings. So some relief there will be good.
Yeah.
I don't think rates are ever going back to 1 or 0.5%. They're probably going back to a rate which is 3 or 4. Which is still a while off, right?
And that should benefit infrastructure and property.
Should,
somewhat.
I mean, property has had
less of a tailwind.
We started investing in global property last quarter. Hasn't been a great decision in the short term. And your global property, we still think it trades at about a 20-25% discount to net tangible assets. There's a few more transactions happening in Melbourne around property, but it should be a relief for infrastructure and for real estate. And there's some really exciting infrastructure assets that are being built and funded.
Popping up, I think it's super interesting what impact interest rates have had. And it felt like they didn't have much of an impact. I mean, talking to friends and family who have mortgages or bought in the last few years, it's been massive. Like the repayments have gone up. If you principal and interest on mortgages that went from 1% interest rate to 5-6% interest rate quite quickly, it's massive. But what impact it's had on the broader economy, you're starting to see trends of more companies going to administration, particularly hospitality and retail sector. property developments, and this probably links to the topic of private credit as well.
Sure.
What trends are you seeing there? We've used a little bit of private credit, but we've been very selective. So maybe it's worth explaining the concept. And
we see some, pain. We're not in the direct side of it, but we see our clients, which are mainly retirees, helping their children because they've got themselves in a bind over buying a investment property or even a leisure property like a beach house that they were able to borrow at 2%, and now they're paying 6.5%. And if you're in Victoria, you've got some extra land tax to pay as well.
Yeah.
And no one really wants to rent those properties. If you look at Airbnb for the peninsula in Victoria, I think it's a record low of transactions over the summer period. So it shows that discretionary money has dropped substantially.
All the lifestyle areas are houses for sale everywhere.
Yeah. So therefore, private credit as an asset class, there's two versions of private credit. Private credit lending to corporates, and then there's private credit lending to corporates that are mainly developers or are in construction.
Yeah.
So private credit has got a couple of things that don't really pass the smell test on the face value for us. The first one is that I don't like is all the fees aren't disclosed to us and to our clients, meaning that every time you originate a loan, if I was a private credit manager originating a loan to you, there would be an application fee, and the application fee is quite high, 2 or 3%. A lot of funds keep that 2 or 3%. So it's in their financial interest to rewrite loans over and over again.
Loans,
if you're a Latrobe, for example, or any of these groups, they're essentially their financial backing comes from taking these origination fees, which I think should be disclosed. I think probably should be shared in some way. And there is also a bias to write more loans, and there's no set origination fee. So riskier loans have a higher origination fee. So it might be 4% to fund you, or 5% versus 1 or 2.
It's like the mortgage broking sector, where it's still commissions are still legal and allowed, whereas in financial advice, not allowed.
Yeah, they're not allowed, right? Yeah. So, but normally they would be represented in your ICR or
lower fee,
but in this sector they're not represented. So you pay the manager 80, 90 basis points and some kind of performance fee, plus they get another benefits and not reflected. I don't think there's any other managed fund sector that actually happens. Maybe in private equity, maybe, but I don't think so. And then, so the structure of it, the framework of it, doesn't necessarily allow for, if the governance isn't right, doesn't allow for the best loans to be in there. And this sector was, called the
shadow or non-bank.
shadow banking sector, and the rise of private credit funds didn't really exist 5-6 years ago, and now there's 130, 140 providers around.
They're huge, and they're taking they're not saying they're bad loans that they're taking, but they're taking loans that the banks don't want to take anymore.
Sure.
That said, the major banks only want to take loans from the wealthiest people and the best people who can service them. So they are filling a gap. It's more because it's so broad and not subject to as much governance. There's a lot, it's all about knowing the manager and knowing their specialty and getting deep on them, which is incredibly hard to
loans, but that's harder. It's
incredibly difficult.
In an equity manager, you can understand the stocks underneath it.
Yeah.
Where when you're in something like this, you're understanding the loans, but each one of them is
and you can get
unique,
them.
Right?
It's like Joe Blow's, mortgage in Hawthorne. It's kind of incredibly difficult to find.
But when it's a development, you have to know, where you sit on capital stack, what the finances look like. So there's been a bit of, they've started probably the cycle. They're starting to go through a cycle where some of the loans are non-performing. They've had to take equity on. They've had to work out. So what does it mean for the sector?
So it hasn't really had this type of volatility and challenges in our career. I haven't seen it in our career.
You could argue the Howard Mortgage Trust and all those historical ones that happened kind of 15 years ago, similar things, loans, and if the company that you're using for private credit doesn't have good governance, doesn't have good processes, doesn't have good spread of loans, doesn't have the expertise for a bit of workout. You would imagine if you're running a book of loans, you have to own something through your duration. So if you own it, what are you going to do with it, and how do you work it out? So I think, like most things, due diligence on about who you use and making sure that they do have all this capacity. The real question we talked about at our investment committee was, what role do they where would you fit them in a diversified portfolio?
Yeah.
And there's many asset classes and investments that we talk about all the time, but when you build a retiree portfolio, you go, well, I've got 7 categories, where does it actually fit? So private credit is one of those for me. There's lots of alternatives to put in, private credit backed by Australian real estate, to put in the same category. So it might be global corporate private credit. It might be real estate. It might be traditional bonds. And then it doesn't really fit in the way we see alts either. Yeah. So it doesn't fit in alts, and it doesn't really, and there's lots of alternatives in fixed income. Yeah. So sometimes asset classes and investments can be excluded, not because you think they're going to blow up or destroy themselves, but because it doesn't fit portfolio structure.
And I think global is much deeper than Australia, as it should be in private credit. But I think the big one and the big thing we always talk about with these investments is that risk reward.
Yeah.
That historically it was like if you're getting 10%, it felt like you're being rewarded enough.
Sure.
But that was when interest rates were 0 to 2%. They're now over 4%.
Yeah.
So understanding. Yes, the 8 or 9% or 10% might look attractive, but what's the comparison in the US, within the sector, in other parts of the market? Are you really getting the reward you should be for the risk in that loan book? And that's so
difficult.
You
understand the risk, right?
Which is where, and I wrote an article about this that'll come out soon, which is where advisors need to be focusing on is doing a lot of work on understanding the risk metrics, the type of risk our clients are accepting before we put them into these sort of products.
Sure.
Because it's very difficult to get the information yourself.
So I think there's still a lot to play in this private credit market over the next 12 to 18 months. If there's 130, 140 odd providers, there'll be a shakeout of that sector, I think. So.
And you got a bit of feedback for our last video that went out too, so maybe that's a good segue into the next topic.
About Trump.
Yeah.
It was
go check out it. Maybe that's important. Go subscribe to the YouTube channel.
Don't look at all the
YouTube
comments.
videos. Yeah.
So Drew and I have been doing a lot more on YouTube, or Drew's been doing a lot more on YouTube. So it's a good way to keep up to date with content we produce. We produce it all the time.
Yeah.
And obviously it's open, so everyone's free to comment. So there's a lot of comments. I think everyone thought I was an absolute Trump supporter, and that's because
you chatted Trump
for promotion and marketing. So, but Trump has won, and the US is changing, and you're probably going to see volatility.
It's coming quick.
Yep.
Yeah.
You're probably going to see volatility in markets for the duration while Trump's in there. So there's going to be pros and there's going to be negatives, and he's changing a lot. This is the whole point of having a diversified portfolio.
What's the pro? America?
I think pro, yeah.
US
Anything
equities.
that's tech has to be pro.
Yeah.
I think maybe geopolitical, if the actual politics of it, not the financials of it.
Yeah.
But I think that's probably a pro.
So we had, I think just last week, as soon as he came into power, he announced tariffs against Mexico and Canada, the two largest trading partners, at 25%.
Sure.
But they then negotiated, and he reversed them in return for changes in I think mainly in their border policy at the moment.
Sure.
But he did apply then another 10% tariff to China.
Yeah.
And then China responded by, I think, announcing competitive investigations into, I think, Apple and Microsoft or Google at the same time. So you're going to see this kind of tit for tat that,
sure.
I mean, for a company like Alphabet and Apple, we know their sales in China are slowing anyway. It may not be as impactful, but it's more the rhetoric and the sentiment in the market that's going to be most impacted by it.
Correct.
Yeah.
And being Australian investors with a diversified global portfolio, you've got lots of different pros and cons.
Yeah.
Trump isn't going to create just absolute negativity that destroys all markets, all sectors, all investments.
All he wants is the S&P to keep going higher.
Yeah. But it's always a balance, right? So if US equities get weaker, probably Chinese equities are going to grow.
Yeah.
How do you diversify yourself and your net wealth? We talk about finite level of capital, every dollar you've ever earned in retirement. How do you diversify that across all these type of risks? And Trump is just another risk.
Yeah.
And he's up for change. So once you're up for change, things
get volatile.
The net result would probably be, not much, but still.
I mean, that's the key. We're not betting on Trump. We're not betting on rates falling when we're building portfolios for clients. Say betting is probably the wrong word to use.
Sure.
But we're not tilting a portfolio to the likelihood that Trump will make all these massive changes or that he'll destroy the global economy. Yep. We're making sure that we're hedging our bets in multiple different outcomes, and we do that through the 7 different asset classes we use.
Yep.
And constantly, and I think the key with that is always going to be there's always going to be winners, there's always going to be losers, and that's why every quarter we're reviewing our portfolios. Every month we're doing investment committee meetings and constantly rebalancing the areas, the companies, the sectors that have gone overweight or underweight.
Absolutely. Okay. So we've this last question that we're going to pose is, should we be investing now? If you've got all cash, 100% cash, Drew, and you've come to me, I'm going to say, Drew, you should wait. You should buy NVIDIA. It's 10% off.
So I think if you're coming in with all cash and you haven't sold, you're not quickly transferring, say, from one super fund to management under us in a super fund. If you're coming from all cash,
let's explain that further for people, because people think they have cash when they come to us, but they've got market exposure in other super funds. Right?
That we then turn into. I mean, if I was deploying cash today, I'm still comfortable buying most asset classes, but I'd probably step it out over a 12-month period. Whether it's 6 months, 3 months, 6 months, 9 months, 12 months, and deploy a small part. Because I know if you're coming from cash, from my experience, that the worst thing that can happen is if you deploy that capital quickly and the market, as it can, turns in the wrong direction quickly, it's going to be incredibly hard to keep you invested and keep you comfortable. So it's more about how do we average that in and deal with the psychology of it, rather than whether that's going to be better or not for returns in a year. And most times we're investing for 30 years, so net result,
if you average in, or if you put it all in a properly diversified portfolio, is probably very similar.
Yeah, exactly.
But you're dealing with
psychological
cycle of having a finite pool of capital and invested into markets.
Exactly. But generally, yes, US share market's been at an all-time high. Plenty of Aussie stocks, and the Aussie share market's really an all-time high as well. I'm still comfortable buying, but I think what I'm not buying is just an ETF or just an index fund that owns those. I think now's the time to pull every lever. So use active and passive managers. So passive is someone who tracks the index. Active is someone like Munro or GQG that are within our portfolios. Investing into a balanced portfolio rather than just stocks. So we're buying some fixed interest, we're buying some gold, we're buying infrastructure as well as shares. And then you're always going to have diversification across companies. So even if we recommend you a portfolio that has 25 investments in it, you're really going to have 500 exposures below that.
More,
at
probably
least.
2,000, right?
Yeah,
so,
exactly.
Yeah, absolutely. The diversified portfolio is, essentially the key to managing a pool of capital and trying to achieve that kind of 7 to 9% return over a long period of time. So,
because we want something, and this came up in a conversation recently, the role of alternatives and the role of fixed income is to have something there to sell, either to fund your lifestyle or cash flow if everything goes wrong and there's another GFC. We can't really compare to the pandemic because we recovered so quickly. And alternatives, in our view, the role of them is to make sure that they hold ground when your share portfolio falls. We then have something that we can sell to buy markets that have become significantly cheaper. And that's where significant returns can be added. Because we know we'll never be able to time the market. No one in history has ever timed the market. And if you miss, we saw in the pandemic, if you miss the worst, if you miss the best days, or you try to miss the worst days, you miss the best days as well.
Yeah, some amazing stats. But I'll show you after this about missing the best days over the last 20 years. And maybe we'll show it on the next episode. And this wasn't a question to start, but gold's at record highs. We made a fortune out of gold. I think we bought it 10 years ago.
2,900 US dollars.
US dollars, yeah.
And then you've got a 0.6 Aussie dollar just keeps tanking to 62 cents.
So if we were true investment hounds, 10 years ago, we would have just put away money in gold.
No one expected it. I mean, the interest rate's higher, was supposed to be bad for gold. Share market's doing well, it's supposed to be bad for gold. Inflation falling, is supposed to be bad for gold. I think it's just proving to be a less correlated asset. So it doesn't react inversely to share markets, but it reacts differently to share and bond markets. I think we've got to remember that because we talk about non-correlated, but that means the opposite most of the time, as opposed to not being exactly the same. But it's been fantastic, and probably an issue we'll cover in the next episode maybe is talking about currency and currency hedging.
Yep. Is that one of your asset classes?
It should be.
Yeah. All right, let's leave it there. Thanks, Stuart. Thanks, everyone, for listening. Been a great episode. If you've got any questions, give us a call.